Most people are waiting for the perfect moment to start investing. They are waiting until they have more money, until the market is less volatile, until they understand everything perfectly. But here is the truth that the most successful investors in the world already know. The perfect moment to start investing was yesterday. The second best moment is right now, with $100. Today, we are breaking down exactly how to start investing with just $100, why it is genuinely enough to begin, what to put it in, how to choose the right platform, the power of starting small and staying consistent, and the most common mistakes that stop first-time investors from ever getting started at all. Number 1, why $100 is enough to start. The biggest lie in personal finance is that investing is only for people who already have money, that it requires thousands of dollars, a financial advisor, and a sophisticated understanding of markets before you are allowed to participate. That is completely false. And it is a lie that keeps millions of people on the sidelines while their money sits earning almost nothing in a savings account. The truth is that investing has never been more accessible than it is right now. Fractional shares, the ability to buy a small piece of a company's stock, rather than a whole share, mean you can invest in the world's biggest companies with as little as $1. Index funds that track the entire global stock market are available with no minimum investment on many platforms. The barriers that once existed between ordinary people in the stock market have been systematically removed over the past decade. And here is the mathematical reality that makes $100 so powerful. It is not about the $100 itself. It is about what the $100 teaches you and the habit it creates. Investing is a skill and a behavior, and like every skill and behavior, it requires practice to develop. The investor who starts with $100 at age 22 and adds to it consistently over time will almost always outperform the person who waits until they have $10,000 at age 35 and invests it all at once. A person who invests $100 per month from age 25 with an average annual return of 8% will accumulate approximately $349,000 by age 65. That is $48,000 contributed personally and $301,000 generated by compound growth. The $100 you invest today is not just $100. It is the first brick in a financial foundation that compounds every single year for the rest of your investing life. Number 2, what to invest in with $100. This is the question that paralyzes most first-time investors. With so many options available, stocks, bonds, ETFs, index funds, cryptocurrency, real estate investment trusts, it feels overwhelming. But the answer for a first-time investor with $100 is actually very simple. Index funds and ETFs are your starting point. An index fund is a type of investment that tracks a basket of companies. Rather than trying to pick individual winning stocks, you simply invest in the performance of the entire market or a large section of it. A global index fund, for example, gives you exposure to hundreds or thousands of companies across multiple countries in a single investment. When the global economy grows, your investment grows with it. The reason index funds are the right starting point for almost every new investor is threefold. First, they are diversified, because your money is spread across hundreds of companies. A single bad performance by one company does not significantly damage your overall investment. Second, they are low cost. Index funds typically charge very low management fees compared to actively managed funds, meaning more of your returns stay in your pocket. Third, they are proven. Over long time periods, the vast majority of actively managed funds fail to outperform simple index funds consistently. The world's most celebrated investors, including Warren Buffett, have publicly recommended index funds for ordinary investors. With $100, a simple two-fund approach works well for most beginners. Put a smaller portion into a bond index fund for stability. As your knowledge and confidence grow, you can adjust your allocation. But for a first-time investor, this simple combination gives you broad exposure, low costs, and genuine participation in global economic growth. What to avoid with your first $100? Individual stocks and companies you heard about from friends? Cryptocurrency as your primary investment? Any investment promising unusually high guaranteed returns? And leveraged products designed for experienced traders? These are all ways that first-time investors most commonly lose money. Number 3, how to choose the right platform. Your investment platform is the account through which you buy and hold your investments. Choosing the right one matters because fees, available investments, and ease of use vary significantly between platforms. There are 3 things to look for when choosing a platform as a beginner. First, look for low or zero trading fees. Many modern investment platforms now offer commission-free trading, meaning you pay nothing to buy or sell investments. On a $100 investment, a $10 trading fee represents a 10% immediate loss before your investment has even had a chance to grow. Start with a platform that charges as little as possible. Second, look for fractional share investing. This feature allows you to invest any dollar amount, regardless of the share price of the investment you want to buy. Without fractional shares, a $100 investment limits you to stocks and funds priced below $100 per unit. With fractional shares, your $100 can be spread across any investment on the platform, regardless of price. Third, look for a simple, clean interface designed for beginners. You will be more likely to stay consistent and invested if your platform is easy to understand and navigate. Complicated platforms with overwhelming dashboards often discourage new investors from checking in and staying engaged with their money. Popular platforms available globally include eToro, Trading 2112, Revolut Invest, and Interactive Brokers, each offering low fees, fractional shares, and beginner-friendly design. Always check the specific fees, regulations, and available investments for the platform in your country before opening an account, and ensure any platform you use is regulated by a recognized financial authority in your region. Number 4, the power of starting small and staying consistent. The most important investing decision you will ever make is not which stock to pick or when to enter the market. It is the decision to invest consistently, regardless of what the market is doing. This single behavior, consistency, is what separates the investors who build real wealth from those who chase returns and end up with nothing. Dollar cost averaging is the strategy that makes consistency powerful. Instead of trying to invest a large sum at the perfect moment, you invest a fixed amount, say $100, at regular intervals, regardless of the market price. When the market is down, your $100 buys more units. When the market is up, your $100 buys fewer units. Over time, this smooths out the impact of market volatility and results in a lower average cost per unit than if you had tried to time your investments perfectly. The mathematics of consistency are remarkable. An investor who puts $100 per month into a global index fund and never stops, through market crashes, through recessions, through periods of uncertainty, will almost always outperform an investor who invests larger amounts sporadically and tries to time the market. The market rewards patience and punishes impatience consistently over long time periods. Set up an automatic monthly transfer into your investment account on the same day you get paid. Remove the decision from the equation entirely. You will not miss $100 if it leaves your account automatically before you have the chance to spend it. But in 20 years, the habit you build today will be worth far more than the money you save by skipping a month here and there. Number 5, common mistakes first-time investors make. Understanding what to do with your first $100 is only half the battle. Understanding what not to do is equally important. Because the mistakes first-time investors make most commonly are the ones that turn a promising start into a discouraging loss. The first and most damaging mistake is panic selling. When the market drops, and it will drop, sometimes dramatically, the instinct for new investors is to sell everything and preserve what is left. This is almost always the wrong decision. Market downturns are temporary. Every major market crash in history has eventually been followed by a recovery. The investors who sold during downturns locked in their losses permanently. The investors who stayed the course and kept contributing recovered fully and in most cases ended up ahead. The second mistake is checking your portfolio too often. Watching your investment balance fluctuate daily is psychologically damaging and leads to emotional decision-making. Check your portfolio once a month at most. You are investing for years and decades, not days and weeks. Not the most experienced professional on the planet has ever known with certainty what the market will do next. Waiting for certainty means waiting forever. The risk of investing is real, but it is manageable over long time periods. The risk of not investing, watching inflation quietly erode the value of your money while it sits in a low-interest account, is just as real and far more certain. The fourth mistake is treating your investment as an emergency fund. Your invested money should be money you do not need for at least 3 to 5 years. Before you invest $100, make sure you have a separate emergency fund covering at least 3 months of expenses in an accessible savings account. Investing money you might need soon forces you to sell at the worst possible time. Start with $100. Pick a simple index fund. Choose a low-fee platform. Set up an automatic monthly contribution, and then get out of your own way. The market will do the rest. Have you already started investing? And if not, what has been the one thing stopping you from putting that first $100 to work? Let us know down in the comments. And if this video helped you feel ready to start investing, hit that like button. It helps Kraftwise reach more people who are ready to take the first step toward building real wealth. Subscribe for a new money video every single week and start building the future you deserve today.